All right, everybody. Stocks by the numbers. Welcome back. Someone asked for a quick update here on Target Corporation, ticker symbol TGT on the New York Stock Exchange, reporting earnings on Wednesday. And if we look here at the earnings estimates coming out here, $2.06 a share on revenue of $24.518 billion. And we go back this time last year, we can see the company slightly beat revenue estimates, posting about 25.3 billion. So they're expecting about 800 million less year over year for Target Corporation. And if we look overall in the numbers, we could definitely make the argument that the stock is undervalued, right? The company brought in almost 32 billion last quarter. The market cap's only slightly double that number, sitting here at less than 72.5 billion. We have a PE of sub 18. The company pays a dividend, right? Yielding out 2.75%. This was the last time we looked at the stock. We saw the topping out here in this range. And also there was the boycott taking place, which technically is still taking place. A lot of people still adamant about that boycott, but we can see the stock. I was expecting about 115, and we continued to break down to the low 100s here, hitting about 103. And then we've been on the up and up. Since then, though, the company has actually technically beaten earnings more times than not. As you see, top and bottom line beat. Slight miss there on the revenue side, which we expected. That's what added to the sell-off. Then the company comes out with a beat on the top and bottom line, starts driving the stock up. Next quarter, they come out with another beat, and that pops the stock back up to 180, and now we've been channeling downward into like this wedge here, it looks like, in my opinion. And technically, we're early here with the apex, but if we do get the positive catalyst that they beat, in my eyes, we could probably pop this back up to 180 plus. But also, I don't know about you guys, but I've been seeing a lot of videos. Obviously, people are highlighting, a lot of retail theft that's still taking place, especially in very, very large populous markets like California. And I saw videos, again, maybe you guys can speak to this, but I saw videos, people specifically actually going to places like Target and showcasing that literally like every pair of pants now has a security tag, and the slightest thing, underwear, deodorant, all of these things, toothpaste is locked behind these glass cases, and everything has security tags on them. So we know that retail theft is still an ongoing problem. And the fact that the company, coming off of some recent earnings beats, the fact that they're anticipating roughly an $800 million drop again year over year, down to 24.5. This time last year, 25.3 billion. So in my opinion, they're kind of, yeah, I mean, you could look at it at both ways, right? It's either A, we lowered the estimates because you're going to make much less money due to theft, probably, and potential ongoing boycotts. So we lowered the estimates because you're probably going to report less. Or on the flip side, because the stock was beaten up and went through the boycott, perhaps they lowballed the estimate, and now, Target's going to come out and post like 26 billion and blow this number out of the water, and the stock's going to jump up to 190. So unfortunately, in my eyes, this doesn't really seem like a clear-cut situation. And of course, we know earnings are a gamble, but, we kind of get more calls right than not, but not really too much, probably like 60-40 split, maybe 65-35 if we have a good week. But in general, we know that earnings are a gamble. In a situation like Target, like I said, you kind of have catalysts on both sides of the fence. So if I personally was to step in on the option side and play TGT earnings, I would more than likely straddle the situation to hopefully try to secure some profits. But in my opinion, I would personally lean more towards the put side. Again, I think that is actually a red flag, because we know that Target's one of those places that kind of sells a little bit of everything, right? And that's why before the boycott took place here in 2022 and 2023, the stock and the company itself was absolutely raging here, getting up to almost $270 a share. Now we're sub 170, so we've fallen quite a bit from those highs that were hit just only a few years ago. And now the stock's starting to make a comeback. But in my opinion, again, it's a company where a lot of people kind of have a little animosity towards it. So if there is any slight negativity reported, in my opinion, I think we're going to chunk it back down here to this trend line. We're going to be looking at about 128.5 here potentially. So in my opinion, again, if you want to be safe, I can understand if you tell me you want to straddle the situation. Personally, I would actually lean more towards puts. But if we look here at recent news, we can see that Evercore ISI raises their price target to 180 from 178. Okay, wow, thanks for coming. Target cuts prices ahead of earnings as it ramps up competition with Walmart. See, that's another thing too. We recently had Walmart beat earnings. So now you can also look at that both ways. You can say, well, Walmart reported, some healthy numbers. They're in retail, so Target's going to post good numbers as well. Or on the flip side, because they're a competitor, you can say Walmart posted good numbers, so they may have taken market share in business from Target, so now Target may miss earnings. So that's what I mean. It could kind of go either way, but Target slides after company to lower prices on 5,000 items to lure customers. That's what I mean. A lot of these places, I feel like they're not even getting customers anymore because, first of all, everyone, obviously, as we mentioned, is shifting to e-commerce and online purchases, which I know that Target and Walmart have this now, but also, again, because they have still so many retail brick and mortar locations, they're basically consistently getting hit and, dealing with loss prevention and all that nonsense. We know consumers are feeling pressured, Target to cut prices. I mean, I will say I give them credit. At least they're trying to appeal to their consumers, their consumer base, unlike something like a McDonald's, which apparently recently mentioned that people making less than 50,000, I think the number was, or 45 or 50,000 for the year in annual income, those are, quote, no longer their like target customers. That's a direct quote from McDonald's. That's not me saying that. So again, that's a story for a different video, but I did mention a while back that, in my opinion, McDonald's is no longer recession-proof. The prices have gotten out of control, and in my opinion, I would not be a buyer of McDonald's, and I would potentially consider buying puts with a lot of time on them to play this sell-off, because in my opinion, I think McDonald's stock, MCD, is going to start selling off here over the next couple of quarters. But let's not get off track here. So Target, recent headlines here, price cuts could help shoppers from pivoting to Walmart. Deutsche Bank, Target increased 209 to 206. That's what I mean. Technically, we could really make the argument that the stock is undervalued in the numbers. Even when the boycott was taking place, I was saying, in my opinion, it actually looks decent in the numbers. So we could potentially get a couple of earnings beats and the stock could start climbing. But it hasn't completely rebounded yet. So Deutsche Bank maintaining like that 200 plus, and even, what was it, Evercore here, 180. I can appreciate that. I can understand that. However, again, in my opinion, I just think that the theft may hinder these revenue and these profitability numbers. Because again, even if they beat or meet on revenue, they may potentially miss on the profitability side because they have to cover those losses. And so you have headlines like this: Walmart's strong forecast signals a resilient consumer. See what I mean? So you have Walmart coming out with some strong numbers, and now they're trying to translate that over to Target. And in my opinion, I feel like there was a shift made, not necessarily that, everything's fine, everything's back to normal, so Walmart beat, so Target's going to beat. Again, in my opinion, if you want to be safe, you could play the straddle, but me personally, I would probably lean more towards puts. A lot of people still have a bad taste in their mouth with TGT. Market cap 72.39 billion. Again, PE is sitting here at 18. And if we look, we can see for 2023 they brought in 107 billion, right? Look at the profit margins, though, fell off a cliff. But again, we had a lot of companies with similar situations. But net margin was up here at about 6.5%, dropped down to 2.5%, rebounded here, still less than 4% to close out 2023. So, lately they've increased the profitability, as you see, last quarter coming in at about 4.33%. But overall, you can see we've kind of plateaued, right? We had a slight bump here from 21 to 22, going from 106 billion down to 106 billion up to 109, and then we pulled back to 107.4. So again, I feel like if people are presented with the option of Target and potentially one or two other franchises to go to, in my opinion, I feel like they're leaning towards the other franchises. And again, this company was on the up and up going into pandemic and even coming out of it. And now it looks like, in my eyes, we may have potentially plateaued, and now we're just kind of hanging out with this flatness. So in my opinion, again, I would kind of lean towards puts on Target, not necessarily calls. How are these sectors here? Home furnishings and decor went down. Apparel and accessories went down. Hard lines went down. Credit card profit sharing went down. But of course, other segments are up. Let's see. EPS, again, has turned around over the last couple of quarters. We have 5 beats in a row, coming off of 3 misses in a row before that. The revenue technically has been strong. I mean, they beat revenue estimates 7 of the last 8 quarters. But again, we know that these stocks work with supply and demand as well, right? So if there aren't many buyers and no one's pumped about the stock, no one's coming in scooping up these shares at 156 looking for that next level up to 180, 200, if people just don't care and they completely redirected their attention away from Target, then it may take much, much longer than even these analysts expect for Target to really jump up and get back to the high 100s, potentially low 200 levels. But we can see even moving forward, Q2, 25.3, that's technically only a slight increase from where they were that time the year before. And then they're expected actually to ramp back up here in the revenue, getting up to 26.1. And then 31.1. See, again, this is their best quarter in Q4. And you can see, look, on estimates of 30.7 back here in 22, they posted 31.4. And on estimates of 31.89, right, increase, they posted 31.92, increase. Now estimates back down to 31. So that's why I say, in my opinion, I feel like a lot of analysts are expecting that this is going to be a rocky year for TGT. And that's why, again, I personally wouldn't be a buyer in my opinion. And you can see even the annual forecast technically below what they brought in and even were expected to bring in for 2023. So of course it is a lower estimate, so that's why I'm saying they could beat it, no problem, and then the stock pops, but also at the same time they could show some struggles, and they can forecast potentially some weaker guidance moving forward below estimates or below fiscal year expectations, right? So we could potentially have a drop down from there. Dividend maintaining. Again, we can see we were in the high teens and even the mid to high 20s on the PE side. Now we're sitting down here at 18, but we were lower for a couple of quarters. That's what I mean. Now we're kind of making our comeback, but we can potentially drop back down again. Anything can happen. Price to sales basically in line, 0.7. Price to cash flow, 8.6. That's the highest it's been going back the last 3 quarters. Price to book now sitting here 5.5 times book. It was higher, but it was down less than 4 times book, so we'll have to see. Enterprise value made a massive comeback, as you see. It went from the 90s down to 67 billion, and now we're back up to about 91.5 billion. That technically is roughly 20 billion on 72 billion, so we're talking like 30% higher than where we're currently trading, which would bring us to about $200+ a share if the enterprise value does come in line with our market cap. We can see our return percentages have been climbing up nicely. Return on equity, the highest it's been. Return on invested capital, highest it's been since going back to Q2 of 22. Same thing with the return on assets. Gross margin took a little bit of a hit. We were climbing up here to the 25s, 26%. Now we're down to sub 25%. Operating margin technically moving in the right direction, almost 6%. That's the highest it's been going back the last 7 or 8 quarters. EBITDA, 8.14%, slight dip from last quarter, but technically higher than it's been. And net margin percentage, same story, up here at 4 1/3%. That's technically the highest it's been. Yeah, I don't know. In my eyes, again, seems like a mixed bag, and we are talking about earnings, which we know 100% a gamble. Please understand the risks involved if you are going to play the earnings on target. Inventory turnover back up to 6.31. That's actually surprising in my opinion, but technically that's the best it's been. Asset turnover, again, how much revenue the company's generating off of said assets on its balance sheet is actually down to now sub 2, kind of back to where it was. Our debt to assets has gone back up. Debt to equity is actually down. Long-term ratios up and down. Switching over here to the balance sheet. we can see assets kind of remained in line. Liabilities came down a couple of billion. Assets minus liabilities yields total equity, and you can see the equity has actually been consistently growing quarter over quarter. We have, we have to call it like we see it. The equity going from about 10.5 billion up to almost 13.5 billion now for Q4 of 23. That, of course, brings up our book value per share, which has climbed now consistently and is now sitting here at 29.09. Cost of goods jumped up here for this quarter, even though the revenue did as well. But we can see on 31.92 billion, cost of goods 24.03. On 31.4 billion, cost of goods 24.5 billion. So they generated more revenue, and it technically cost them a little less to do it compared to Q4 of 22. So technically, that is a good sign. Revenue minus cost of goods sold yields gross profit. We can see profit hitting almost 8 billion. That's the highest it's been going back the last several quarters. Operating expenses jumped up from the 5 billions now up to a touch over 6 billion. Gross profit minus operating expenses, operating income, we can see 1.87 billion. That's the highest it's been going back the last several quarters. So this is why, again, from a fundamental standpoint, as an analyst, if you are eliminating the kind of like social feeling, the social vibe behind Target, and again, people hating on it, people boycotting it, if you push all that to the side and you simply look at the numbers, then I can appreciate the fact that a lot of these analysts, again, are pretty bullish on it and still, maintain higher price targets. The debt here, 20 down to 19 billion, 19 billion, 19 and a third, back up to 21 and a quarter billion. See, that technically, the debt is up about $500 million from the same time last year, even though they generated basically the same revenue with lower cost of goods sold, right? We just looked at that. So technically, those numbers are heading in the right direction, but of course, the debt is technically up. Cash sitting here, 908 million. That's slightly higher than that time last year. Free cash flow is now the highest it's been going back the last 4 quarters, slightly higher than where it was in Q4 of 22. But we do have the short-term liabilities outweighing the assets, long-term assets outweighing liabilities. Again, mixed, really mixed, could go either way. And if you're bullish on this, I can understand why. And if you're bearish on this, I can also understand why. But some people may kind of be saying, hey, listen, the boycott's over, the news cycle ended, so everyone's going to just kind of forget about it, and now they could potentially beat, and it's going to go up. But in my opinion here, I am expecting, I am leaning more towards the put side, and I would say a drop down into the 130s, potentially even 128. Let's check stock charts real quick. On the weekly, next pivot point down would be 138.12. If they do beat, they would probably pop above this resistance level here and potentially be on their way to this level of 211. But 138.12 in my eyes, that seems very reasonable. 50-day about 136.5. Yeah, that would actually be lower if we drop down. So maybe if it does happen to miss, we may hit this fib level here of about 139.59. Again, I'm looking at the 1 year. MACD recently crossed to the downside a couple of weeks ago. Stock's been pulling back, recently rejected off the 200-day moving average. But again, we never know if earnings are coming Wednesday, right? The stock could be up Tuesday, Wednesday going into these numbers, so 152, 145, and then down to 137.21, potentially back to the 200-day moving average. This is possible if the numbers do come in light, or if they do mention, again, about the rampant rise in theft and the fact that they had to spend all that money to lock everything behind plexiglass. And the MACD recently looks like it actually crossed to the downside. So, yeah, I may be looking for like 139 to like 136, right? We have like multiple levels of support and moving averages and fib levels around that price range. But I will say, if we go all the way back here to December, that is what, about 6 months straight that the stock has been above the 200-day moving average. And also, that was when it got up above the 50-day moving average back mid-November of last year. And you can see it tested it once, twice, And now just within the last couple of weeks, it recently broke below it and has stayed below it and has not retested it. That's why I'm saying with potentially these estimates being lower now year over year, everyone may be kind of leaning more towards the put side here. But RSI below mid-range here, sitting here at 40 on the daily. And on the weekly, we're middle of the road here at 53.5. We recently topped out. We've been pulling back. So that's why I'm saying we can potentially close out today down, 2.5%. And we could potentially rise tomorrow with these earnings coming soon. But, yeah, in my opinion, I would lean more towards the put side. But again, that is just my opinion. But let's check the Bollinger Bands real quick, I guess. Yep, we can see we're right here at the mid-Bollinger Band, 156.63, stock 156.35. So it looks like it tried to bounce off of there, so we may kind of hang out here until we get these numbers. And on the daily, yep, you can see couple of rejections here recently off of this mid-Bollinger Band, so we may actually bring this stock down to the bottom of this range here, about 154.40, before potentially having a slight bounce going into those earnings. But I don't know why, but in my opinion, I do have a feeling that this one drops down, and I think we see the mid to high 130s on TGT. But again, earnings 100% a gamble, so please understand the risks involved if you are going to get involved. But again, technically, once all the dust settles, and if Target is able to get back in the good graces of the average consumer, then in my opinion, the stock may be off to the races. And again, the stock was up here at almost around 270 before the boycott and all that negativity began. And they lost, like 60% of market value. So technically, the numbers are there, and a lot of them are moving in the right direction. So if they are able to beat, and again, kind of wash out the bad taste in everyone's mouth, then in my opinion, the stock can easily rally about 100 points from this level and go from the 150s up back to the 250s where it was. Of course, that's probably going to take several quarters, potentially 9 to 12 months in my opinion. But of course, we never know what the company may announce, right? They may come out, they may beat on the top and bottom line, they may announce a buyback or something, who knows? Right? So we could, of course, again, have a potential spike up to the 180s, or we could drop down here to the 130s. So again, in my opinion, if I was going to personally play it, I would lean more towards the put side. But of course, better safe than sorry if you'd like. And if you straddle this one, I would understand. But I'm going to end it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky and volatile and very uncertain. So I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. Have a good day.